You want monthly income. You've heard of JEPI, JEPQ, and SPYI and their incredible yields. But what if the very income you're chasing is silently draining your wealth after taxes? What if the best income ETF isn't what it seems once the IRS takes its cut? Today, we're not just comparing yields, we are revealing the shocking truth that most investors completely miss. This isn't just a showdown, this is about transparency so that you can take an eyes wide open approach towards how you can build an effective path towards financial independence. So if you're trying to choose the right income ETF, but the options are overwhelming, and the tax implications feel like a black box, you're seeking clarity and you are here to find out which ETF truly puts more money into your pocket after it's all said and done. And if you're new to our channel, hi, I'm Stefanie. Welcome to Permission to Be Wealthy, where me and my husband, Joseph, have open and honest conversations with you about what it's like to build wealth, invest, and pursue financial independence with balance. We've been living a life abroad for 7 years, 3 of which we've been navigating as a financially free family of 4 right here in Portugal. I know talking about ETFs and taxes can feel like navigating a maze, but don't worry, I'm going to be your guide today. We're going to break down the essentials in plain English so that you can take an informed decision. We're going to talk today about quickly refreshing what covered call ETFs are with JEPI, JEPQ, and SPYI as our examples. We're going to discuss why they are so incredibly popular. And then we're going to get into the stuff that no one wants to talk about, at least in detail, and that is taxes. And be sure to stay to the end of the video where I'm going to reveal a secret weapon that's going to help you keep more money in your pocket. So what exactly are covered call ETFs and how do they generate this additional income? Let's break it down simply. Imagine a typical ETF like the S&P 500 index fund. It owns a basket of stocks, and a covered call ETF takes that one step further. In addition to owning that basket of stocks, it also sells call options on them. Think of it this way. When you sell a call option, you are giving someone else the right, but not the obligation to buy a specific stock from you at a specific price and at a specific date. And in return for granting that right, you immediately receive a payment called a premium. So let's say that you own a share of X for $100 and you write a call that says it goes up to $105 in 30 days, and you give someone the right to buy that stock for $10 for that call option. No matter if the price goes up to the 105 or not, at that specific time frame, the call option generates $10 back into the fund. Covered call ETFs collect these premiums and then they distribute that income to their shareholders, which is us. And it's a strategy designed to generate higher, more consistent income streams, often at a monthly basis, regardless of whether the market is going up or down dramatically. So now let's get to comparing our 3 covered call ETFs today. Our contenders are JEPI, the JP Morgan Equity Premium Income ETF, JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF, and SPYI, the NEOS S&P 500 High Income ETF. So let's start with JEPI, one of the most popular income ETFs out there. JEPI focuses primarily on large cap equities, essentially the big stable companies in the S&P 500. It is actively managed, meaning that the team is consistently making decisions about what's in the fund, and it uses a strategy involving something called ELNs, or equity-linked notes, along with selling out-of-the-money call options. What you need to know about JEPI's numbers is that its expense ratio is 0.35%, its 12-month trailing yield is 8.10%, and it pays out monthly. The big upside about JEPI is that it's got lower volatility and some consistent income, but the trade-off often is that it's got capped upside when the market really rockets. Next up, we have JEPQ, JEPI's cousin, but with a different flavor. While JEPI is a broad market ETF, JEPQ is focused on the NASDAQ 100, meaning that it's packed with growth-oriented tech stocks. Like JEPI, it's also actively managed and uses a similar strategy with ELNs and call options, but applied to those higher growth tech names. JEPQ shares JEPI's 0.35% expense ratio. It also pays out monthly. However, its 12-month trailing yield is higher at 11.56%. For its pros, you get higher growth potential and that higher yield, but be aware it also comes with higher volatility because of the tech focus. And finally, our newest contender, SPYI. SPYI focuses on the S&P 500, similar to JEPI, but it also employs a unique option strategy. It's also actively managed, but it often uses what's called 0DTE options, and that means 0 days to expiration options, aiming for a more balanced total return rather than just pure income. SPYI is slightly higher with an expense ratio of 0.68%, but it boasts the highest 12-month trailing yield at 12.50%. And yes, it also pays out monthly. The potential pros for SPYI are that potentially better total return and a very dynamic strategy, but it's a newer fund with less history for us to look back on. And now for the critical piece of the puzzle that dramatically changes the true value of your income, how the IRS taxes those dividends. This is where most investors leave money on the table, often thousands of dollars annually. And to be transparent, we have fallen into that trap before as well. First, let's distinguish between what qualified and non-qualified dividends are. Qualified dividends are the efficient kind. These are essentially payments that you receive from a company's profits, typically whenever you own their common stock. Think of dividends from solid, established companies that you might find in the S&P 500 index fund, for example, or in ETFs like VYM, or SCHD. The big advantage with qualified dividends is how they are taxed. They get those favorable capital gains rates, which, as you can see on the screen, could be as low as 0% or 15%, or for higher earners, 20%. Notice how wide the 15% tax bracket is. For a married couple filing jointly, that covers incomes from nearly $97,000 all the way up to $600,000. That is a significant amount of income that gets taxed at a much lower rate, which is why these are often preferred by investors. Now, on the flip side, we have non-qualified or ordinary dividends. These are dividends that, for various reasons, don't meet the IRS's rules for those favorable lower tax rates, like dividend distributions from non-US companies, companies not listed on the US exchange or stock market, or income made from hedging like premiums. And here is the crucial connection to our covered call ETFs like JEPI, JEPQ, and SPYI. A significant portion, or sometimes even all of the distributions for funds like XYLD and QYLD, you get from these funds, they're often considered non-qualified. Why? Because a lot of the income comes from option premiums, not the traditional profits that the underlying companies have already been taxed on. And that is the fundamental difference that you have to understand. So when it comes to taxation, these non-qualified dividends are treated just like your regular earnings on your salary, your wages, or any other ordinary income. That means that they are taxed at your higher ordinary income tax rates. As you can see in this chart, your ordinary income tax rates can be significantly higher than qualified dividend rates, just as we discussed. And here's the kicker. The dividend premium income that you receive from covered call ETFs is an example. That is an addition on top of your other ordinary income whenever you're calculating your total tax bill. So if you are already in a higher income bracket, this extra income could push you into an even more higher earnings bracket and a higher tax tier. So you're already seeing that the high yield isn't enough. It's the type of yield that matters. You're gaining crucial insights most investors never bothered to uncover, at least until it's too late. And before we reveal the ultimate after-tax winner, if you're serious about maximizing your income and dodging hidden tax traps, you know what to do. Hit that like button right now. It's going to tell YouTube that this in-depth content is valuable. And subscribe to our channel, plus hit the notification bell so you don't miss my next deep dive into smarter investing. All right, so let's pull this all together and see the true after-tax picture. We're going to use a hypothetical scenario. Imagine you have $100,000 invested in each of these covered call ETFs. And based on my actual 2024 annual statement for JEPI, we'll assume that 17% qualified dividend mix for all three funds, and the rest is going to come from those higher tax options, the premiums. For our tax calculation, we're going to assume that you're in the 22% ordinary income tax bracket for non-qualified dividends and 15% capital gains tax bracket for the qualified dividends, assuming that our scenario has someone making $62,800 in annual income, which is the average income in the US coming out of 2024. So let's look at the numbers. For JEPI, with its 8.10% trailing yield, that means that you make about $8,100 in annual income. After factoring in all the taxes on its qualified and non-qualified portions, you're going to be left with approximately $6,414 in income after tax. That's going to give JEPI an after-tax yield of about 6.41%. Moving on to JEPQ with its higher 11.56% trailing yield, that is roughly $11,560 in annual income. After those same tax assumptions, JEPQ will net you about $9,154 after tax. This translates to an after-tax yield of roughly 9.15%. And finally, SPYI, leading with 12.50 trailing yield, generates about $12,500 in annual income. But here's where it gets interesting. After applying the taxes, you'd be taking home approximately $9,899 after tax, and that means SPYI has an impressive after-tax yield of 9.90%. So as you can see, when you peel back the layers and account for taxes, SPYI, despite its slightly higher expense ratio, actually delivers the most after-tax income in this scenario, followed closely by JEPQ and then JEPI. This really underscores the point that the headline yield is just the beginning, and after-tax yield is really what matters for you and your wallet. And remember, this is based on a specific tax bracket and a hypothetical qualified dividend mix. Your individual tax situation is going to vary, so always consult a tax professional. So now let's take this further and see how these funds do in a bear, a bull, and a sideways market scenario. And to help compare versus a traditional qualified dividend fund, we're going to add VYM into the mix. For our bear market scenario, we're going to use 2022. This is where income-focused strategies were really put to the test. And first, VYM, with its typical 2.80 trailing dividend yield, generated about $2,800 in annual income for that same $100,000 investment. In a bear market year, VYM experienced a capital loss of around 3%, so negative $3,000. So even with its income, its total return combined was negative $620. Next, JEPI, with its higher yield, 8.10%, generated about $8,100 in income. However, in the bear market, its capital depreciation was more significant, around 14%, resulting in a negative $14,000 capital loss. So when you combine that income with JEPI's total return, it was overall negative $7,586. Then we have JEPQ with its even higher trailing yield, 11.56%, giving us that $11,560 in annual income, but it's focused on more volatile tech stocks, meaning that there was a steeper capital loss in 2022, 28%, so a negative $28,000. This left JEPQ overall with the largest total return loss of $18,846. And finally, SPYI, with its 12.5% trailing yield, generated that $12,500 in income. Its capital loss was similar to JEPI's at 14%, or negative $14,000. So that resulted in an overall total loss of negative $4,101. So what does this tell us? In a significant bear market, while covered call ETFs do provide a high income stream that can help cushion the blow, they are not immune to capital depreciation. In this particular bear market example, while VYM also had negative total returns, the covered call ETFs generally saw a larger capital loss due to their equity exposure, even with their substantial income streams combined. So clearly, in this scenario, VYM was the winner here. So now let's look at the flip side. In a bear market, let's see what we saw in 2024. This is where the characteristics of covered call ETFs really differ from traditional growth or even pure dividend funds like VYM. So let's start with VIM, our benchmark for qualified dividends. With its 2.8% trailing yield, it generated $2,800 in annual income, but in a bull market like 2024, VYM saw significant capital appreciation, about 14%, adding $14,000 to our $100,000 investment. That brings VYM total return to a solid $16,380. Now let's compare that with our covered call ETFs. JEPI, with its 8.1% yield, it gave us that great $8,100 in income. However, because it's a covered call strategy, its capital gains were capped. showing a more modest 5% gain or $5,000. And when added that to the income, JEPI's total return comes to $11,414. Next up, we got JEPQ with its higher 11.56% yield, provided $11,560 in income. Its NASDAQ focus allowed for higher capital gain of 13% or $13,000, leading to a strong total return of $22,154. JEPQ's growth-oriented underlying assets, even with the covered call overlay, allowed it to capture more of the market's upward momentum in this scenario. And finally, SPYI with its 12.5% yield gave us the $12,500 in income. Like JEPI, its capital gains were also around 5% or $5,000, bringing SPYI's total return to $14,899. What this illustrates is a key trade-off in a roaring bull market. Traditional growth-oriented funds or even broad market dividend funds like BYM can capture a significant capital appreciation, leading to strong overall returns. Covered call ETFs by design cap their upside potential in exchange for consistent income. And while they still provide a positive total overall due to their high distributions, you might miss out on some of the explosive gains experienced by the broader market. JEPQ, with its tech exposure, managed to capture more upside than JEPI and SPYI, showcasing its unique position and popularity in this category. Okay, so now let's look at the sweet spot for many income strategies, a sideways market. This is where the overall market isn't making big moves up or down, it's just trading in a range. And for example, we're going to use a hypothetical 2025. I used year-to-date numbers here, where this is the kind of environment that might play out. For VYM, with its 2.8% dividend yield, you got that $2,800 in income. In a sideways market, we might see a small capital gain. So let's say 3% or $3,000. So VYM's overall return is going to be $5,380. Now, for our covered call ETFs, this is often where they can really stand out. Even if their underlying assets don't gain much, they're still collecting those valuable options premiums. So for JEPI, with its 8.1% yield, generating $8,100 in income, even with this small capital loss of 2%, its total return still comes in at $4,414, even after tax. The high income helps offset that slight capital dip. JEPQ, with its 11.56% yield, that $11,560 in annual income, even with a larger capital loss of 6%, $6,000, after taxes still delivers a positive total return of $3,154. And again, that substantial income helps to counteract the capital movement. And finally, SPYI, leading us to 12.5% yield, that $12,500 in annual income, even with a small capital loss of 2%, negative $2,000, SPYI shows the highest total return at $7,899 in a sideways market. This is where the strategy really capitalizes, extracting premiums even when the market really isn't going anywhere anytime fast. And as you can see in a sideways market, the strong income generation from these covered call ETFs becomes a real advantage. While VYM still performs positively due to its dividends and a slight capital gain, the consistent and higher incomes from JEPI, JEPQ, and SPYI allow them to deliver competitive and, in SPYI's case, potentially superior total returns, even with some minor capital fluctuations and taxes. This is precisely the kind of market where their strategy is designed to shine. Now, of course, I'm interested in a full step back and a longer term analysis on this, aka multiple years, and that video is something that I'm planning on making soon, so make sure that you stick around. Based on our after-tax income calculations for that $100,000 investment in a specific tax bracket, SPYI edged out the competition, delivering the highest after-tax income. However, it is crucial to understand that best is subjective. JEPQ offered higher overall potential in a bull market due to its growth exposure, while JEPI offered more stability. So what is the best way to effectively manage taxes when it comes to covered call ETFs or things that have non-qualified dividends? Well, first off, tax advantage accounts when you're still in the accumulation phase. Roth IRAs in particular give you the ability to access your premium income without taxes as long as you're 59 and a half. Keep in mind that you can also access the principal of what you put into a Roth if you keep reinvesting those premiums to allow the count to grow. If you're in early retirement, taxable brokerage accounts are typically the ones that we leverage. So avoiding taxes isn't fully possible, but now there are balanced dividend premiums and qualified dividend options like DIVO that you could consider. Plus, your tax bracket is key. I have a video about opening a Roth IRA linked in the description below, or you can find that linked up here somewhere. So to bring this home, a type of dividend income matters just as much, not if more, than the headline dividend yield. Tax efficiency is paramount, and understanding how your income ETFs are taxed can save you thousands annually. No single ETF is a set it and forget it solution. Your choice depends on your risk tolerance, your income needs, and your tax situation. So the elixir that you're returning with isn't just one ETF. It's the power of knowledge, and it's understanding that the real yield is the after-tax yield. It's knowing that the diversification, even with income generating assets, can be key to balancing risk and reward. You now know to look beyond the flashy yield number. You understand the profound impacts of qualified versus non-qualified dividends. You are empowered to ask the right questions and to make a decision that is truly going to put more money in your pocket. The journey into tax implications of income ETFs is just one step on your path towards financial independence. It's about taking that permission to be wealthy mindset seriously by being informed and being proactive in your journey. So if this breakdown helped you, and if you're ready to master even more of these crucial wealth building strategies, there are two things that I want to ask of you today. Click the like button. It helps this video reach more people like you. And subscribe and hit the notification bell. We're going to keep diving deep into strategies that actually move the needle for your financial freedom. And for 1 week, I'm going to keep the link to the Excel that I use to build all the content for this video in the description below. So be sure that you're checking in whenever I put out a video, because some of that stuff is going to be available for a short period of time and then it's going to be gone. And until then, I hope this video gave you a little bit more food for thought on how to give yourself permission to be wealthy.